today's episode, we're going to discuss what to do when the market dips. How should you react and what actions should you take? We're going to explore all of that and more with real examples from my portfolio. But first, if you want a channel that's going to help you speed up your journey to financial freedom through dividend growth investing, stately investing is the place for you. So hit that subscribe button below. Let's get started. So, what to do when the market dips? We've seen in the past week and a half or so that the market has been dipping. The technology stocks out there and the NASDAQ have come down quite a bit from their highs, their previous highs in, last week. And so we're going to talk about what you should do when the market dips. The first thing you should do is pause and evaluate. So what I mean by pause and evaluate is stop and don't panic, right? So don't have an emotional reaction to prices of the stock market. If you are a dividend growth investor, which most of you are who are watching this channel, you know that dips in the market are temporary, right? It all depends on your timing perspective. So if you're looking to be a true investor rather than a trader, and you guys can remember my video on trading versus investing, I'll put a link up top. If you look at a long enough time period, this is just a temporary blip, right? Or a temporary dip in the market. So what you want to do is pause and not react to that. The second piece of that is evaluate. So you want to look at the stocks that you have, see how they're reacting, right? Because just because the overall market is dipping doesn't necessarily mean that your individual stocks are. So like for example, in this past week, tech has gone down quite a bit, but most of my stocks aren't actually in tech, or at least most of my dividend stocks aren't in tech. So if we look at my dividend portfolio, dividend income portfolio, most of my stocks actually weren't too bad off. So why don't we look at an example from my portfolios? All right, so we are looking at the weekly view here of my passive income portfolio in M1. You can see that I am down about 0.62%, which isn't too bad for the week. If I were more heavily invested in tech, I think that would be down even further. And you can tell that I'm down around $219. My net cash flow in was around $250, right? So putting some money in, that's my usual normal investment. And then I've lost around $220. So overall, you can see that it doesn't look too bad. We can look at my holdings, and my holding values overall. Like, let's assess the portfolio overall and look at unrealized gain. And this is the top, right? But you can see that for the most part, I'm up across the board, right? And this is, again, looking at a much longer time period, but you don't see any huge drops, right? What's my lowest unrealized gain? That's Walgreens, right? So Walgreens has actually been kind of tanking in the past few weeks, but I've recently invested in Walgreens in this portfolio, and that's only $250 some of my portfolio. Same thing with Edison International, 190. Gilead actually has been a bit of a drop in the past few weeks based on some bad news about one of their drugs in the pipeline. So you can tell that like nothing major has happened where my entire portfolio is down. And so that's what you want to do when you're evaluating. You want to look at reality. So you might hear all of this negative news and you might hear all of these bad things going on, but in reality, let's stop and take a look at what your actual portfolio is doing, because it might not be as bad as it seems out there. So once you do that, we can move on to the second step. So the second step is to buy what is undervalued. You guys will remember a video I had that was called buying things on sale or buying stocks on sale. This is what I typically do when the market dips, right? If I have looked at the stocks that are out there and I have a watch list, or I have things that I know I'm just looking to wait for that right price, then now is the time to strike, right? Don't be timid or don't do the opposite and sell things that you actually want to buy at a lower price, right? So a lot of people panic. So they skip past step number one and they panic. And then they do the opposite of step number two, which is to sell a bunch of stocks. And so what you want to do is actually buy what's undervalued. And this leads into dollar cost averaging. So dollar cost averaging is when you continue to buy at lower and lower prices so that your overall cost is going down for that stock. We'll take an example right now from my portfolio. All right, so if we look at my portfolio, my Robinhood portfolio, which again is mostly dividend growth, or actually all dividend growth stocks, If you look at it for the week, I was down almost 1% or over $160. But you can also go into my activity. So let's go into my account here and go into my history, and you can see all these dividends that are about to occur, right? That's great. But let's look at the orders here. If we look, you can see that I made some purchases, some fairly large purchases in the past week and a half or so. Last was Raytheon Technologies (RTX). You can see that I purchased around $300. This had been on my watch list for a while, and I said basically the next time there's a dip or a significant kind of price down, I would buy into RTX. And so I did that during this recent dip. Similarly with Bank of America, I've been trying to buy at low values here and trying to get to the undervalued pieces of Bank of America, get it at prices that I think are the right price for me. So if we go back to my account and look at Bank of America, you can see exactly what I'm talking about with dollar cost averaging, right? So my average cost is $25.96, which is above the current price of $25.49. And so in order to get my average cost down, I need to just keep buying when when the price is actually lower, right? And so that might be a little counterintuitive because we want my overall return to be higher, right? And you can see right now that my total return is negative by about 2%. But basically, I'm just going to keep buying this, right? Like if I bought it at $25.96, then it makes a lot more sense to buy it at $25.49. And so you want to be able to keep making periodic purchases at lower prices. So that way, when the value does go back up, you can stop that buying, right? And see the rewards of buying things at such a lower price. So you're just investing for your future. And additionally, when you're looking at dividend stocks, you're looking at the yield. So as the price goes down, the yield goes up. And as that yield goes up, that is an indication to buy. Right now, you don't want to buy anything that's super leveraged or super risky. Again, you have to consider the fundamentals of the companies that you are buying. But in this example, right, I'm going to continue to buy Bank of America because I think it's poised for success in the future. And it's at prices that I consider reasonable, so that I'm going to keep buying if the price keeps going down. So let's move on to the third step. So the third step is to continue your regular investment schedule, right? So keep going at your regular investments. Part of this has to do with dollar cost averaging. You want to just keep purchasing. You don't want to break up your schedule. But additionally, remember, time is your biggest friend and ally in investing. So the more you invest, and you don't want to pause your investments because the stock market is down. It's the exact opposite, actually, right? You want to be buying at those lower values, but you just want to, you can't really time the market. So you want to just keep regularly investing. You want that compounding to work, right? So the earlier you get started, the more you benefit from compounding, and you want to just keep at it. You don't want to take out any money. You don't want to sell any stocks. You want to be patient. And remember that dividend growth investment is not a short-term gain, right? You're looking at long-term wins here, not kind of short-term wealth boosting. And so let's take an example. Let's look and see how my M1 account, which is where I make my periodic investments, let's see what I'm doing there. So here's an example of activity in my M1 account. You can see there's a bunch of dividends, which we love to see, right? You can see all that there. But then you can see the buys, right? So here's a buy where I did my normal $250 investment. And then in the previous week, there should be another buy. Let's see. Where is it? Right here, right? So another $250 investment. And that's basically just showing that no matter what is happening, whether the market is going up or going down, I'm just going to continue to make those investments. Now you can see, obviously, I did see where the market went down, and I actually went and bought a large amount. The market happened to be down quite a bit overall on that particular day. And so I put in a deposit and I bought a bunch of shares. So that goes back up to step number 2. But in step number 3, we're talking about just your regular periodic investments. Continue to make those. Don't freak out. Don't panic. So in all, like, you need to put all 3 of those steps together. So let's jump back and look at all 3 steps in summary. So remember to pause and evaluate, step number 1. Once you've done your evaluation and can see if there are things out there to buy, make sure you do it. Don't be timid. Don't be afraid to buy things when they're on sale. Remember that dollar cost averaging is going to work out for you in the end. That's step number two. And then step number three is just to continue your regular investments. Don't break up the schedule. Don't do anything weird. Just continue to make those investments because timing and compounding are your best friends. Now, remember, all of this strategy assumes that you've done your research on your initial investments and that you have mostly high quality stocks or funds. So you don't want to have anything super risky in your portfolio. You don't want to make an even bigger bet on something that's super high risk. This is just assuming that you're using mostly high quality dividend growth investment stocks and you've done the research on the companies that you're investing in. So hopefully this advice was helpful for you guys today. I wanted to give you some practical examples of what I've been doing in my portfolio overall. And I hope you stay safe out there. Have a good week, and I'll see you again in the next episode.